Hi everyone, welcome back. I'm Kirill Talai, investment analyst with over a decade of experience. Here we connect the dots between macro, crypto, and AI. No noise, just what actually matters for your portfolio. Today I have two stories for you. First, let's talk about Iran. It has been a while. The ceasefire looks officially over. Oil had its biggest single-day jump in 6 years on Monday, and the US president announced a 20% toll on everything that moves through the Strait of Hormuz, and then canceled it within a day. I want to walk through why I think this whole escalation still fades. And the second story, the market. A lot of volatility over the first 2 days of the week, so let's unpack it and see if our scenario for summer holds. Let's dive in. Quick disclaimer, nothing on this channel is financial advice. I'm sharing my views and analysis, but you always do your own research.
This video was created in collaboration with the IT company Anderson.
Let me start with Iran. The ceasefire, it looks like, is officially over. And here's how we got there. Iran kept hitting commercial ships in the strait, one or two at a time, calling them regulation violators. The regulation in question is that Iran reads the deal as forcing ships onto its own coastal route, where it plans to charge transit fees. The US reads the same deal as guaranteeing the southern route by the Omani coast. Ships kept taking the southern route. Iran kept shooting at them, and the US got fed up eventually. The response is forceful. The US started hitting hundreds of military targets across the coastline. The naval blockade of Iran is reimposed, and for about a day, the US wanted to collect fees for the passage through the strait. And that was ironic, considering the US was opposed to this exact idea when Iran wanted to do it. More on that toll in a minute, because it did not even survive the day. Now, why did the ceasefire break at all? I think you have to understand what is going on inside Iran, because Iran is not one player in this game. There are two groups. There is the secular leadership, the president and the government, which is directly negotiating with the US and has every incentive to comply with the deal. Compliance means sanctions relief, investment, and money flowing back into a broken economy, and the political credit for delivering it. And there are revolutionary guards who sit on the opposite extreme. Their incentive point the other way. They control the boats and the drones. A quiet strait makes them irrelevant. A hot strait makes them indispensable. And if Iran ends up collecting transit fees, they're the ones holding the toll booth. So the guards profit from non-compliance, even when the country as a whole loses. These two groups are fighting each other for control of the outcome. And every time the diplomats get close, a commercial ship gets hit. And one more detail that makes this structural rather than temporary. Since the assassination at the end of February, the new supreme leader owes his position largely to the guards' backing. So the referee in this internal fight is not really neutral. The US has finally internalized this. It looks like Washington keeps negotiating with the government, and Trump said on Monday that a deal is still possible. But the strikes are aimed squarely at the guards, at their coastal infrastructure, at their ability to touch shipping. So talk to the government, shoot at the guards. That is the actual policy now, it seems. Then there is the toll, or rather there was. 20% was an enormous number, roughly $15–16 a barrel on the crude cargo at current prices. It looked like a random number, and I suspect it partly was because this is the president's standard negotiating pattern. Escalate hard, scare everyone at the table, then pull back and take the deal that looks moderate by comparison. We have seen this movie with tariffs more than once. This time, the whole cycle took just one day. The toll was announced on Monday, and by Tuesday it was gone, replaced, in the president's words, by massive trade and investment deals that the Gulf states will be making into the United States. The speed of that reversal tells you a lot about how the rest of this escalation campaign likely resolves. Now, the market. Oil spiked almost 10% on Monday, the biggest single-day move in over 6 years. And WTI is trading at 80 as I record this. Here's the context that matters though. During the acute phase of the war, $90 was roughly the floor, the low of the range. So we are one big headline day off the recent bottom and still well below where the market traded when it genuinely feared the strait closing for good. The market is repricing risk, it seems, but it is not panicking yet. Also, the positioning was extremely crowded on the short side before the escalation started. So I believe we also have some technicals contributing to the move. And I think there is a good reason the market should not panic, and the reason is the supply math. Start with the American problem. The strategic petroleum reserve is effectively empty. It is sitting at its technical minimum. So the buffer Washington used through the acute phase is gone. That is a real constraint on how long the US can afford this. But the bigger player is on the other side. China still has its reserves, and China has spent the whole war acting as the swing factor in this market, cutting its imports from close to 12 million barrels a day before the war and to under 9 million, which absorbed most of the global shock. Beijing has both the inventory and the flexibility to decide whether this market trades oversupplied or in deficit. And at this stage, it's hard for me to see why China would not cooperate. Expensive oil hurts them more than anyone. They have publicly called for the strait to reopen, and they have every reason to keep releasing and keep prices contained. So my base case remains that this fades. Some form of de-escalation, potentially even by the end of this week. The near-term risk is simply more rounds of volatility like we saw on Monday. And that's it, I think. But here's the part I think outlasts all of these headlines. Across the region, you can see tremendous efforts going into one thing: getting around the Strait of Hormuz. Pipelines that bypass it are being maxed out and expanded. Cargoes are being rerouted. Iran played the hostage card. They played it once and it worked once. Over the next 6 to 12 months, the supply chain adapts permanently, and structurally there will simply be less traffic, less dependence, less leverage running through that strait. So, to summarize the Iran story, the escalation is real and stronger than before. My base case is still that it fades on a timeline of days to weeks. And the toll already made the point for me. Announced Monday, cancelled Tuesday. The lasting trade is the world de-risking itself from Hormuz. Now, the market update. Because underneath the war headlines, the more important repricing this week was happening in rates. Yes, oil spiked, and yes, the dollar caught a bit on the escalation. But look, at the size of that dollar move, about 1/3%. For a shooting war at the world's key oil checkpoint, that is remarkably shy flight to safety. Well, I have been positioned for the dollar to roll over, and the stronger dollar, even marginally stronger, is a headwind against that call. But the muted size of the move tells me the dollar rollover thesis is wounded, not dead. So the real action was in rates. By Monday's close, the 2-year was back above 420, and the 10-year around 460. And here's the thing, the trigger was most likely the speech, not the oil move. On Monday, Governor Waller gave a speech and he came out hawkish. He said Fed may need to raise rates in the near term if inflation keeps running well above the 2% target, and that the central bank cannot afford to be asleep at the wheel if the incoming data break the wrong way. He also produced the line of the week. He said that without a hard numeric target, inflation becomes like pornography. I can't define it, I can't measure it, but I know it when I see it. And that, he said, is not how central bankers should think about inflation. Well, that was a very controversial comparison for a central banker, I must admit. Now, why did the market care so much? Two reasons. First, Waller carries real weight. He's one of the most respected voices on the board, the kind of governor whose arguments move the committee. And the market knows it. Second, the irony of who's saying this. Just a couple of months ago, Waller was a leading candidate for the Fed chair, and his platform, in effect, was multiple cuts this year. He did not get the job, and the man who passed over as the dove is now out hockey the chair who beat him. Whatever you think about the personal dynamics there, and I have my suspicions, the signal to the market is clear. When even the committee's most prominent dove is talking about near-term hikes, the center of gravity has moved. Rates were priced accordingly, and I think the Waller speech, more than the war, is what pushed yields higher this week. The oil situation just added fuel on top. And Waller said one more thing. He said June inflation trend would carry heavy weight in deciding whether the Fed should hike or not in July. He deliberately put enormous weight on a single data point. And well, on Tuesday morning, that data point arrived. And it came in soft. Not soft in the way everyone expected, genuinely soft across the board. Headline prices fell 0.4% on the month, against expectations of -0.1%, which took the annual rate from 4.2 all the way down to 3.5%. The market expected 3.8. But the number that really mattered was core. Core inflation came in at 2.6%, down from 2.9 when the consensus saw it barely moving. And that breaks the pattern, because core had been quietly accelerating for these 3 straight months. And that acceleration was the backbone of the entire near-term hike case. Waller asked one data point to referee the hike debate, and the data point ruled against him. The reaction was immediate and very risk-on across the board. Rates fell, the dollar sold off, metals caught a bit the moment the print hit. So I think this inflation report was the last chance for the Fed to hike interest rates this year. I think that story is now over. With the monthly core inflation at 0 in June, it is really very difficult to make the case for interest rate hikes. However, if the war escalates further and I'm proven wrong about it ending soon, we might get another round of gasoline inflation in the summer, and that might complicate things. But again, I do not think so, as I mentioned before. Just a reminder of risks that one should consider. So, where do we stand? We said last Monday that the AI trade is probably over for the summer. It needs some time to catch its breath. That looks like it was a good call. Then we also said the dollar should weaken and the rotation in the market should continue. I think we're well positioned here too. The dollar has not rolled over yet, well, at least decisively, but I think it should happen soon. The scoreboard is here on the screen. So let me pull it together. On iron, the escalation is real, but the toll that lasted one day tells you how this resolves. And my base case remains de-escalation, potentially within days. And whatever deal gets signed, the Strait's leverage over the global economy peaked in February. The world is rooting around it permanently on the market. The important hawkish tone came from inside the Fed, not from the war. And the one soft inflation print pushed straight back. Core breaking lower killed the near-term high case, and the market went straight back to risk on. And the playbook stays what it was: defensive rotation on, patience on the hottest names, and the weak dollar trade finally getting some help. For the timely calls in between these videos, follow me on X. It is linked below. And that's it, guys. If you got something out of this, hit subscribe and like, and I see you next week.